Well, hello everyone. Welcome to Covered Call and Short Puts. Mr. Cameron May has a well-deserved day off today, and so I am happily filling in for him. Today, we're talking covered calls and short puts, and specifically, we're going to talk about buy right covered calls today. We're going to talk about how to evaluate different strikes and why somebody might consider selling a strike in the money versus at the money versus out of the money. And so that's what our conversation is going to be based around. I see a lot of the usual suspects have shown up today, and it's great to see you all here. If you're joining us for the first time, I want to welcome you. Feel free to type a greeting into the chat so that we know that you're here. So hello to Will and Greg and Scott and Mark and Jackson and Michael and JDLMI and the rest of the gang. Thank you all for being here. We have Mr. I'm thinking it's a Mr., but it might be a Ms. Lemansky, who said, "Can we do an in the money covered call today?" And so yes, we're going to look at that as a strategy, and thank you for suggesting that. And somebody else mentioned I had just posted something called, it's a short video on a candlestick pattern called Three Black Crows. And I know the commenting, if you say it's turned off, I believe you, we'll get that turned on. So check back later this afternoon and that should be working. So, let's get right down to business. If you are not following Scott and I on X, we have Mr. Scott Thompson with us in the chat today. So you're going to want to follow both of us on X. Scott is a friend, a fellow coach, and one of the managers here in the coaching area. So you've got a wealth of experience coming at you. And as many of you know, I joined first as a client, and Scott was one of the first coaches that I followed on a regular basis. So it's always great to have Scott and to get to team up together with Scott. So Scott Thompson CS on on X rather, Barb Armstrong CS. You can now also find us on LinkedIn as well. So wander over to LinkedIn and you can find us there. Just as a quick reminder, when we sell a covered call, that is an option, and options do carry a high level of risk and aren't suitable for all investors. Also, we are using the Paper Money software application on the Thinkorswim desktop platform, which is a great place to learn, to make sure you understand your trading plan, that you have a trading plan, that you understand the mechanics of how the platform works. But know there are some nuances and differences, and with covered calls, that is a short option and it can be assigned at any time up until expiration. Now, that's not always a bad thing, but it is a thing. But know that that thing will never happen in paper money. It won't be assigned early in paper money. That can happen in a live account. Also, when we use stop loss orders, it doesn't guarantee if we use a stop market order that we're going to get out at the price we've requested. If the stock were to gap down, like IBM did a week or two ago, or like Google did on earnings, it's possible that we could get out at a lower price. Okay. Yeah. So Mark is saying I might agree to 2 black crows, but it seems a little early to say 3. A full disclosure, I probably spent 2 hours looking for 3 black crow examples, and they were not easy to find. The market has been pretty bullish. But it's a very specific candlestick pattern. And so you'll have to go watch the video if you haven't seen it. Because today we're talking, we are talking about, we're talking buy right covered calls. So let's get right out to the platform. Okay. So, and this is a strategy that it can be considered to be bullish and it can be considered to be a neutral strategy. And it just depends on what your goal is and how you're trading it. So like if you own a stock that was going sideways for ages, like Uber has been in this sideways range for quite some time, if you owned it, you might want to sell a covered call when it comes up to the resistance level, around this 78 level, and maybe buy it back when it came back down to 70. So that's a strategy. Some people will use a covered call where they already own the stock and they're selling a covered call and they don't want to get called out. They just want to make some money as the stock is busy going sideways. So, but let's say you're looking at a stock that's been uptrending. And one of the stocks that we talked about in trading a smaller account today was Philip Morris, which, it's up 21% year to date, but it went through this period of consolidation. And I posted this on X as well, that we saw this cup and handle pattern setting up on X. And it looks like it's potentially, just let me get my drawing tool geared up here. Here's our cup and here's our handle. And in that class, and if you missed it, you can go back and watch it in the recording. But, we have this range, it's about $39 here. And so if you wanted to do a longer term trade, you could say, well, I'm going to add $39 to this 192. Sorry, I've got my little calculator here, plus 39. So I'm going to put my target way up here around 230 or 231. Okay. Now you might be in that trade for months, but let's say you want to take a portion of your portfolio and have some income generating strategies where, that you're not putting a ring on it. You just want to place a shorter term trade where you're going to be in and out within, say, 15 to 40 or 50 days. And you just want to make some income. And, like I like to say, it could be your Paris for Christmas fund. It could be your pay off your credit card debt fund. It could be your take the kids to Disney, buy a new car, like whatever. So for that, you might want to use something called a buy right. And you can use a buy right for different reasons. But one of the reasons or ways you might use it is to say, I believe, based on this technical analysis and what I saw after the recent earnings, is that this stock is going to continue to go up. And it's sitting at 195.54. I'm going to sell a covered call kind of in the middle of the road where I believe it's going to get run over and I will be called out. So the goal is to be called out and to add some money to that kitty for whatever you want to generate that income. Maybe you're retired and you just want to make an extra, 2 or 3 grand a month. It might be 500 a month. It might be 5,000 a month. That number is up to you. But, could a strategy like this contribute to it? And so if we close my drawing tools and we come to our trading plan, and the other thing we may want to do, like I brought up the live news on Philip Morris, and it's like, you may want to check in and just say like, hey, what are the analysts thinking? Since, we just had earnings on this. Well, Stifel raised their price target to 205. Needham raised the price target to 215. Goldman Sachs to 220. Morgan Stanley to 215. It's currently trading at 195. And it's interesting to me, but these prices tend to go from like 205 to maybe 220-ish. I'm going to put an ish on that. But so if we said, well, if we come out to August, so this is only 25 days away, it's currently trading at 195. Well, if I sold the 195, which means I'm willing to sell it for 195, like less than what it's currently trading for, they'd give me $6.40 for that. And if you want to look at an example trading plan, and I'll show you, an example trading plan I created, a little video, kind of the guideline that we created, and it has 5 components: what to buy, when to, or when to sell. So when to trade, what to trade, how much to trade. So that's your position sizing, when to exit, and what are your routines. And so if we look at this, one of the caveats is, does it trade 1 million shares a day or more? Check. Does this have at least 20 times the number of contracts we're going to trade? Well, we have, almost $1 million in this account. it's trading at 195. We might say, we're cool with a $40,000 position. So we could maybe do two contracts and buy 200 shares. So we have 1,000 shares on this at the first strike in the money, if you will. We have 31 contracts. So we could do one contract here. We could, if we looked at the 200, we have 1,750 contracts that were on the books when the market opened this morning. We have, contracts that traded on all three of these strikes, 100 on the 200 strike, 29 and 28. So we'd be good actually to do two contracts on any of these. Then the next one is, is the bid-ask spread tight? And our way of defining tight is it less than 10%? So we've got 50 cents here on a $5 wide, strike. So we're cool with that. We've got 20 cents here on the first strike in the money. So we've got check, check and check. And then on the chart, we had, technically an entry. So check, 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 check. Okay, so now the next question is, well, what strike do we choose? And so if we said, well, you know what? If I really want to be called out, if my goal is to be called out, now, and if we're not called out, there are other things that we can do. But if our goal is to be called out and it's trading at 195.67, even if it just stayed hovering around here, if I sold that first strike in the money, what are the probabilities? And so I've got up here probability of in the money and probability of touching. And I don't know why this doesn't say 100% because we are touching this now. But what this is saying is that there's a probability that this will at least kiss this between now and August 21st. So obviously it's kissing it now because we're at 95, 195.58. We have a 50% probability of it expiring in the money at expiration. So that means we have a 50% probability of whatever it is that our max gain is that we might make it. Now, if we come up to the 200 strike, we're getting $2 less, but then if we're called out, we're being paid $5 more because, this is saying we're willing to sell the shares at 200 versus 195. But the probability of it being in the money at expiration is lower. It's 37%, although you still have a 76, almost a 77% chance of it at least playing kiss and tell with, the 200. But the 200, is a big number, for it to break through and stay broken through. So it may kind of hover around that for a bit. And so if we wanted, and I don't typically do an example where it's in the money, but I know that for some traders, this is a popular strategy because their probability of being called out is higher. And so if you say, okay, well then if I did that, how much could I make? Well, I like the way you're thinking. So, how much you could make is 195 minus what you're paying to get in. And so if we look at this and we say, okay, 189.09. So the most I can make is $5.91. So if I were to make $5.91 per contract, and I divide that by my price of entry, which is 189.09, we'll just go with 09. That would be a 3% return for a trade that, I might be out of in 25 days. And so if you said, well, I'm cool with that, and that would add nicely. And if I can do two contracts, I could make, that amount times two. And so, we could do this and say we're going to do two contracts, or you could do one of these at 195. And then, especially this is paper money, this is a class environment, and then we could do one at the 200. And if I get to fill in for Cameron again, we can kind of review these. But so let's put one in here. Now, one of the caveats in our example trading plan is, when are we getting out? Well, if we're called out, we're getting out at 195 come August 21st. But what if the trade goes against us? Like it could come back down here and come all the way back down to 153. Do we want to take that ride? Well, we might say, here's a recent low here of 187.31. If it goes, say, 2% below that, I'd like to exit. Like, because this is my, take the kids to Disney fund or whatever it is. And I don't want to be in this for this long a ride. So we're going to come here and we're going to take our single order, make it a first trigger sequence, and create an opposite order. Now we know that if we are stopped out, we know that the call that we have sold will be worth less, but we don't know exactly what it'll be worth. So we're going to make this a market order that's good till canceled. We're going to click on our disappearing, reappearing sprocket and say, hey, if Philip Morris goes at or below 183.56, it's not going in the right direction. And so we would like to exit that position. And so this will say, hey, just FYI, the most you can make on this is $584. And it doesn't take the fact that we have this stop loss in place. It's saying, if the stock were to go to zero, you could lose 18,918. I did include the short premium, James, because if you look here, the stock is currently trading at 195.96. So we've taken this, our net price to get in is 189.17. Okay. So this is what we're investing to get into this trade. Okay. So we're going to put this in our buy right covered call group. And then if we wanted to do another one to compare, because we could do a 40,000 position, we could do one here and then just compare and contrast them. But know that if we sell this 200 strike, although technically we could make more, the probability of us making that max amount is going to be less. Okay, so we're buying, and we call this in Thinkorswim speak, buying covered stock. So now we could make $8.52 on an investment of, I didn't get my decimal in there, so I'll leave the decimal out on this one, 191.53. So now we could make, a 4.4% return. So a higher return, a higher number, but the probability of us achieving it is going to be less. And then we're going to put in, repetition is the mother of all learning. Our stop loss order, we're going to put in our stop at the same place. So it's a market order, good till canceled. If it goes below 183.56, we want to exit. $183.56. Okay. And then I'm going to type in here. So this is going in our buy rights that we're going to compare to the in the money 195 strike. So there we go. So now we've done two trades, and we've done one where the strike is in the money, and the second one where it is out of the money. And it's still, it's really, it would be hitting a new all-time high. And so, what if it came up and if we put our strike here at 200? So if we're looking at this one, for example, because the odds are higher, that it will not be at 200. So if we have our line here and we say, okay, if this were to come, and let me bring up my drawing tool. Okay. So let's say the stock comes like this and it goes through our strike and keeps on going. Well, are we going to be crying the blues because at expiration, let's say it finished at 210? No, because we agreed with ourselves that we would be happy to get out if it hit 200 and if we could make a 4% return in, about 3 weeks. It had 25 days. So there's no crying if it goes up. But if it goes up and then, say, comes back down and expires here, when it gets close to expiration, we might be able to buy this back. If we sold it for $4 or $5, we might be able to buy it back for 40 or 50 cents close to expiration, and we still have the stock. And so, if we still have the stock, we could then wait for it to bounce and come back up and then sell another one at either 200 or maybe, at 205. Or what if, it came up and then we get to expiration and we were going to just let it be called out. And, on expiration day, it ends up closing at, 190, 198.50. Well, chances are, and we can be called out at any time prior to expiration. But if we go into expiration and it's trading below 200, chances are we get to keep the stock and we get to keep all that credit. And then if it's at 198.50, maybe the next one we come out, we say, okay, yay me, I got to keep that, 400 or 500, whatever it was. So these are still working. So we said we wanted to pay 191.53. It's now saying we want 191.62. So if we come in and cancel and replace, you know what? We'll give you 165. We're feeling generous. Okay, so that's filled. So now when, if you want to see this, when we come in here and this one, 189.16, they now want, a few more pennies. So let's go in. We'll give you, and we're going to compare to the 200 strike. Oops. I can't type today. So now when we come in and we look at these, we can see, we got paid $4.40 for this. So, if it gets to the point where we could buy it back for 50 cents, we might just choose to do that. And then if it went up and goes through our strike and we get called out, like let's say the stock, some news comes out and the stock really goes up and we get called out next week, prior to expiration, are we going to be sad? No. We just got our max gain weeks ahead of when we thought we would. We're going to be popping the champagne and doing the happy dance. So being called out or being assigned isn't always a bad thing. Especially with a trade like this where, we're selling this covered call and our goal is to be called out. And if you want to see this on your chart, we can just put it on here and then we could add another line for that 195 to just remind us that we've done two trades, and we're going to compare these different strikes. And again, that's August, and that stands for buy right covered call. Okay. Let me just have a look. Yeah, Mark says, if I get called out at 220, I'm a happy trader. I would be too. But not everybody would. like some people, they have a different set of parameters that they're trading within. Um, okay. So Sam was running the numbers. Yes, Goldman is bullish on Philip Morris. Yeah. Yeah, I'm laughing at the Black Crow things. Do you know, like, because I was thinking there was one where there were like 6 or 7 big bearish candles in a row, and it's like, oh, there's a flock. But actually, with crows, it's not a flock, it's called a murder. And if you have 5 or 6 big bearish candles in a row, it's kind of murdering your hope, for anything bullish, isn't it? Um, the English language, I don't know how they came up with that, but they did. Okay, let's look at, and banking has been a strong sector. So if we look at financials, so this is the S&P 500. It's just it's an industry watch list, the sector indices here. And if we click on financials, it's hitting a new all-time high today. And it was on the struggle bus for a bit. Like, here's our, cup and handle pattern on this index as well. But this sector's been pretty bullish. And so if we come and look at Bank of America, it's on the other side of earnings, which we're looking for. Like 30% of the S&P 500 companies that make up that index are reporting earnings this week. So we're in the middle of earnings season. And so some people, as part of their trading plan, they might say, one of the rules I'm going to make is that I don't trade this over earnings, because stocks can gap up over earnings. And this one, they announced some stuff pre-earnings, and here we had a pretty dramatic move to the downside on IBM. Google, like, I mean, their earnings announcement, they beat, like, look at this, 9/11 was their actual earnings per share return. The street was expecting 287, and the stock tanked. So why did it tank? And you're going, but it's Google, and they're doing all these cool things. And it's like, well, they're planning on investing heavily. So their capital expenditures, they're investing. And the street apparently didn't like that, because look at what happened with the stock. So and it might be a good company, and they might be doing good things, and they may have totally crushed it on earnings, and still the stock can gap down. And so one of your rules just might be, I'm not going to play that game. I value the lining of my stomach. I don't want to be chewing Tums. So, I'm just not going to trade this income generating strategy this over earnings. Okay. So, if we come up here and we say, okay, Bank of America, but this candle is a red candle today. Well, this is another way we can look at a buy rate and say, but if I'm okay with owning the stock. And if we come back and we look at the live news, like, so, we just had earnings not long ago here, and it beat, not like Google did, but, so Seaport Global is, upping the ante to 71. Well, it's currently at 62 from 69. Evercore raised their price target to 67, CICC to 68. When I'm kind of you may just want to be scanning and saying, like, are analysts raising price targets or lowering them? And they all kind of seem to be in this 61 to 68 range, RBC to 65. So if you're saying, okay, well, it seems to be pretty bullish, all around, could I come here? And even if it comes back down, like, let's say Bank of America does come back down to around the 60, if I sold the 63 strike, I'm going to get more for it if it's up closer to 63. And then I can buy it back if it comes down to 60. Now, this might only be a 1-day pullback, like here, 1-day pullback, 1-day pullback, 1 day. Here was 2 days. Ooh, here we had 3. But we haven't had more than a 3-day pullback since May. So here, if we come to our trade tab and we say, well, if I sold this 63, or here is interesting, like the 62.50, you don't typically see this kind of volume on a 50-cent strike. You know, like we've got 24,000 contracts at the 65 strike, but this 62.50, you know, we've got a 3-cent bid ask spread. So, you know, if you go back to your checklist, and I'll show you where to find that example trading plan. But if you say, does it trade 1 million shares a day or more? Check. You know, do we have lots of volume? You know, and if we're looking out 15 to 50 days, does this fall within it? Yep. And do we have lots of volume? You know, tons. Like, and it, you know, even if we say we can do like a $40,000 position, so we could do, you know, 6 contracts, you know, we've got hundreds of contracts here. So we'd want there to be at least 120 contracts. Well, we've got that. So if we said, okay, well, this came almost up to 63, I'd like to sell this 63. They'll give me $1.04 to $1.07 for it. Now, this is not a stock that's considered to be very volatile. And so you may not have the kind of premiums that make it, you know, super delicious, but, you know, then there's less volatility. And, you know, so your next question might be, well, if I sell the 63, is there enough juice to make it worth the squeeze? You know, and if we come to our buying covered stock, it's like, okay, so the most I can make on this is $2. Well, that doesn't seem like a ton. Well, it's $2 on a $60 investment. So if I could make $2, and let's just call it 61, divided by 61, that's still 3% for 25 days. I mean, that's not too shabby. It's 3.3% if you want to get particular. So if I said, well, if I did 6 contracts, okay, how much am I investing? 36,000, is it lower than 40? Yep. So am I okay with that? Yeah. And then what's the other thing? Well, you might say, if this were, you know, $1 million account, just to make the math easy pour moi, you know, if you wanted to, if you're willing to risk half of 1%, that would be 5 grand. So we're risking 36,000 technically, unless we put a stop in. So where might we put a stop? Well, we might say, here's our recent low here at 60.37. So I'm going to take this 60.37 times 0.97. So some might use 2%. I'm going to use 3 just in this example. So we're going to say we're going to put our stop here at 58.55. And again, one of the advantages of selling this call is that if it does come back and we end up stopped out, you know, that dollar we get paid, or whatever that amount is that we got paid, will help ease the blow. It's not going to eradicate all of the loss. So we're putting our stop at 58.55. So single order, first trigger sequence, right click, opposite order. And again, market order, because we don't know exactly what that call that we sold is going to be worth. We're fairly confident it will be worth less, but we don't know exactly what that'll be. But if the stock goes at or below 58.55, we'd like to trigger a market order to buy back the call that we sold and then to sell the stock. Okay. So if our exit is at 58.55, how much are we risking? Well, we're paying 60.94. So if I say I'm paying 60.94 and I subtract the 58.55, we're risking 239 a share times 600. So we're risking about $1,400. Now, you know, if it gaps down, we could be out for less, but $1,400 is a long way from our 5,000 max risk. So we should be okay. there's never any guarantees, but this idea of entering the trade when it's close to the strike we want to sell, knowing that it might pull back and giving it enough room to breathe. My dad used to say there's a delicate balance between giving teenagers enough room to breathe and enough rope to hang themselves, like meaning really get themselves in trouble. So we want to give this stock enough room to breathe, so that if it does pull back, we don't get nicked out and then have it go up and, we would have had a profitable trade. Yeah, so Sam is saying this could be a bit of an overload, but when we do our trading a smaller account class, and I would have liked to place this trade, but we have a $5,000 max position size in that class, and so we couldn't trade that because it was just that teensy bit above our max position size. But if you had an account in that neighborhood of $1 million, and you might say, okay, a $40,000 position, so 966 divided by 40 divided by 966 is how I should do it. That's a 4%. So if we said we don't want our max position size to be more than about 4% or 5%, we would be okay with that position size. Yeah. But you might choose one of the things when you have multiples of something, like we have 600 shares here, is that you then have the choice of, well, I'm going to buy back 300. I'm going to close out 300 and leave the other 300 on. Like that might be a choice. Okay. Okay. So let's look at a couple of other financial stocks. So if we look at KeyBank, again, here we have this cup and handle pattern. It seems to be like what all the cool kids seem to be doing these days, right? So we have this cup and handle pattern, and then it broke out. So we had the breakout, came back to retest. So it retested here, came up and hit another new high, and then it came back and it's retesting again. But the technical analyst in us might be saying, I hear what you're saying, but we have 3 down days. And yes, we have this big, I don't know if you'd call it an inverted hammer or an inverted mallet, because there's a pretty big body on this thing. But you may say, you know what, I am going to exercise some caution here because I want a higher degree of confidence that this old resistance level is going to continue to hold as new support. And so I'm going to look for a Harami pattern or a bullish engulfing pattern or any number of candlestick patterns that might give us confirmation. This candle does not tell us that this stock may be done falling yet. And so we may want to wait, but that's one that, we may want to have on our radar for, yeah. Somebody said that's an inverted cricket bat. Thank you. That's a better one. That's a better analogy. And if we look at Wells Fargo, now, this is more of a double bottom, right? And we just came with earnings. And, like I've got a 1-year chart up. This is the highest earnings. So it beat on earnings. And we had this double bottom pattern. So when we're looking for example trades, like one of them is, do we have a technical entry? But, we've been getting a lot of chatter here, but this is one where you may want, to consider selling a strike that's closer to being in the money. Yeah. Yeah. So I did promise to show you, so if we came out and looked at this, it's trading at 87.30. We might want to sell something closer to where it's currently trading. So we might, if we wanted to do this shorter term, August 25th, we might say, hey, this 88 strike, that's only 70 cents away. But if we could make $1.80 plus that, or now if you come up to the 90 strike, we've got, an 8-cent bid-ask spread. But, the bid-ask spread isn't, it's only 15 cents here. So it's acceptable, and if you're saying, if it comes up to 90, I'm okay with that. Now, 90 is kind of the tippy top of where it's been recently. But your probability of being called out is going to be higher, the closer you go to where it's currently trading. And so if you said, okay, well, if I did this, where would I be? And run your numbers. So if you could make 256, and you say, okay, I can make 256 on an investment of 85.44, that's a 3% return. And what we're seeing is pretty consistently with these banking stocks, this, our volatility is under 30. If we were to come and look at something like iron, where volatility is at 130%, here we have a $35 stock and they're paying like over 10% of the stock value just on the strike alone. But it's a very volatile stock. And so you've got to have a stronger tolerance for risk. Okay. Okay. So we've got 5 minutes left and there's a couple of things I promised to show. So we're going to, if you're new and you haven't signed up to Trader Talks, you're going to want to subscribe to the Trader Talks channel. 206 or 8,000 people can't be wrong, right? It's a free service offered by Schwab Coaching. And then when you first get here, what you'll see is what's currently being taught. If you come to playlists and you scroll down, so here's this 3 black crows we were talking about in the bite-sized content. We've also got a whole group of them kind of linked together on the trade management mini session. So I'm pointing this one out just because if you want to do some binge learning and you're going like, she was talking about this bullish Harami and bullish engulfing, and I don't even know what that means. Well, here's a 3-minute video that goes over bullish engulfing. And, when I was talking about inverted hammer, here's a 4-minute video on that and a 5-minute video on a hammer. And there's one on Haramis. Well, there's 15 of them. So, here's one on Haramis. And then if you continue to scroll down, so we've got this kind of greenish, turquoisey, I don't know what color you actually call that. But if you come down here, here's an example trading plan for buy right covered calls. And it's 20 minutes long, but it gives you that framework from which you can create your own trading plan. And somebody said, do I have a video on selling strikes that are in the money? And I don't specifically have one dedicated to that. We talked a little bit about that today. And just the biggest advantage of that is your likelihood of being called out. And like I said earlier, I mean, one of the things that you can do, and you can customize your charts. And that's another thing. Like if we come back here, if you keep scrolling down, so then we have this aquamarine color, and there's one on customizing the option chain. Oh, maybe that one's gone now. I'll have to do a new one. Adding monitor notes. Okay, you'll find it here and I'll record a new one. And it's just on, there will be a new one on how to, on Thinkorswim, how to quickly customize your option chain. I guess that one, okay. I'm still, I can't believe that it's gone and I didn't realize that because I usually re-record them right away. These will be up here for about 2 years and then I'll record a new version of it. So look for that kind of by the end of the week. I'll record another one, but let me just bring Thinkorswim back up. So in here, you can come and you can see I've got Barb's basics with probability and in the money. But if you bring up one here, let's say you have volume and open interest, which you want, you can then right click and customize that and add your probability of in the money if you'd like to add that, and then probability of touching and add that. And so if you wanted to add those and then say, I want to save that, and I'm going to call this Barb's probability in the money and touching. And you can save it. And then the next time you click, when you come down here, you'll see, all the ones that you have saved. Okay, so that's pretty easy to do. Okay, so guys, there's a survey in the chat. Here's the deal with the survey. If you click on that, there's 2 questions, and it's super easy. 1 means I hated it, 10 means I loved it, and I'm going to keep coming back, and then there's everything in between. You can add comments if you like. So if there are topics you'd like to see us cover in future, I'll pass those along to Cameron. My commitment to you is if you fill it out, I promise to read each and every one, and so will Scott. Hit the like button, subscribe to the channel, and don't forget to follow us in the land of X and LinkedIn, Barb Armstrong CS and Scott Thompson CS. So thanks to Scott for being here and the guys behind the scenes who make the magic happen. Thanks, guys. Up next is, Liz Ann live. I can see her face. Is Liz Ann live? So stay tuned for that at the top of the hour.